Good morning, everybody. My name is Anthony Kazazis, and I am the director of the NYC Network Group, as well as the NYC Real Estate Expo. And I'd like to thank everyone for registering onto today's webinar, DMG's New Direction, Finance and Acquisitions in Multifamily. Our sponsor for today's webinar is DMG. Founded in 2013 and headquartered in New York, DMG is a leading global real estate investment management and development firm focusing on student housing, condominium, multifamily, and modular construction. By combining the joint expertise of their talented people, they offer clients a vertical integrated investment platform resulting in outstanding reliability and the prospect of share growth. In today's real estate world, against the backdrop of COVID-19, industry leaders are facing enormous challenges and opportunities. From acquisitions and constructions to sales and operations, every aspect of the real estate world has been influenced by this new norm. This series will guide participants on new innovations in construction and offer insight on investment strategies in multifamily assets. Challenges and opportunities for new developments, as well as techniques for new sales and marketing strategies, will also be discussed. On November 5th, Part 1, DMG discussed modular housing and new innovation in construction. They discussed the overview of the impact of COVID-19, how to better manage the construction process, how to better manage costs and operations, what green materials can be utilized for the future, and they touched on the future of modular and what's next. Today, Part 2, our speakers will talk about the new direction of F&A, Finance and Acquisitions in Multifamily Assets. They will discuss the current market of student housing and multifamily, why invest in student housing and multifamily industry, F&A challenges during the pandemic, how are investors in equity sources from around the globe approaching the current environment, is there a trend of net buying or selling in 2020, what is DMG's unique approach towards selecting assets. At this time, our guest speakers are Ariel High, Senior Vice President of Finance and Acquisitions at DMG Investments, John Harrington, Principal Founding Partner at HKS Capital, John Haltmeyer, Managing Director at Castle Placement, and Douglas Lopinto, Vice President of Finance Acquisitions at DMG Investments. At this time, I would like each of our speakers to give a short 1-minute introduction on themselves. And let's start off with Ariel. And Ariel?
Thanks, Anthony, for the introduction, and good morning, everyone. This is Ariel High from DMG Investments. I'm the SVP of the Finance and Acquisitions. So as Anthony introduced, DMG is a New York-based company specializing in condo, multifamily, student housing development, and the investments. So with projects across the United States, the total AUM of the company is it's above 700 million. So very honored to be here, and thanks for joining us.
John Harrington.
Yeah, thanks, Anthony. I've been on the broker side of the CRE finance business for well over 20 years. I believe I've developed industry relations with most of the commercial banks, as well as various life companies, specialized opportunity funds. I've worked with most of the CMBS lenders, as well as agency, Fannie, Freddie, the DUS lenders, and structured probably every asset class there is for acquisition, refinance, bridge, value add, and I've done a lot of construction loans over the years. I know that a lot of brokers may shy away from that because it's its own niche, but you know, I always find it interesting to work on a project that goes vertical.
Thank you, John. I do want to apologize. I forgot to mention our moderator.
My name is David Goldwasser. I have an advisory firm called FIA Capital Partners. We mainly deal with advising distressed owners and or work with distressed assets who find themselves in situations that they normally aren't in. whereas their loans are behind and they have to negotiate with their lenders, or they find themselves with partnership disputes or trying to fund some of their projects that have run amok with some city issues, and advise people, going through the bankruptcy process. So I'm involved in those areas with my firm for the past about 25 years. And most of our projects and advisory work is in New York City, although we do nationwide projects and select larger markets for clients of ours.
Thank you, David. Thank you. And David will be our moderator today. John Holtmeyer.
Yes. So I am with Castle Placement. We are a boutique investment bank. We're based in New York. We focus exclusively on raising private debt and equity for really any kind of company or platform. We do almost any industry other than crypto. We stay away from crypto. That FINRA does not like crypto. We believe we distinguish ourselves by having a very robust technology. So we combine old-fashioned sort of personal touch investment banking with a database that has hundreds of thousands of investors in it, all with detailed criteria, gives us very broad, efficient reach. And we also give our investors and clients access to our system so they can log in and see who we're talking to, and they can join in on the discussions and so forth. So we think it's kind of unusual and unprecedented in the investment banking world to provide that. I've been with the Castle Placement almost 5 years. Prior to that, I've had experience, sell-side experience with CIBC and JP Morgan as a telecom banker. I've also been a credit research analyst for a company called ACA Capital. So I have a pretty diverse background in finance for about 30 years now.
Thank you, John. And Joseph and
And
Douglas.
thanks for having me, by the way.
You're welcome. Thank DMG. Douglas?
Yeah, thank you. My name is Doug Lapinto. I'm Vice President of Finance and Acquisitions at DMG Investments. I'll be jumping into a corporate presentation to kind of give everyone a better overview shortly, but I have a background in finance, starting off with Prudential Financial, working for several family offices, and most recently working with DMG Investments, leading their finance acquisitions team.
Thank you, Douglas. And I think you have a presentation that you're going to show us.
Yep. Let me pull it open. So this is DMG's corporate profile. I'll run through this quickly for everyone's benefit so we can get into the discussion. But our website is dmginvestments.com. AutumnLiving.com is our student housing brand, Autumn Living. We have a brief introduction. This video will be available to the members of the audience after the webinar. But DMG takes the coronavirus, and it's really impacted everyone's business, as we were talking about before this webinar. It's impacted people being able to live on campus, be educated in person. And DMG has really made a point of making sure that our properties are best in class from a wellness perspective. It's a safe space for students. We have rigorous sanitation standards, and it's really benefited our properties as we've moved through this uncertain time. As Ariel mentioned, we have a nationwide portfolio. So our properties are from the Midwest down to Texas, across to the Carolinas, and a lot of properties near our home base in New York City. So we are really a broad multifamily developer, sponsor, and co-investor. We have a condo project in New Jersey. We have several student housing properties in upstate New York. We have student housing property in the Carolinas. We have a couple of multifamily projects under contract in this area as well. And we have multifamily properties in Texas and the Midwest as well. This is a sample of our portfolio. This is just our student housing properties. And our company typically adds about 3 to 4 new projects every year is kind of our cadence right now. Our company is in 5 different markets. We have, as I said, 3 to 4 new pipeline assets. We have 1,000 beds under management, or 1,300 beds under management, and 1,000 beds in our pipeline right now. We have projects in Albany, New York. We really like the SUNY system. Our investment criteria for student housing really is focusing on a lot of these secondary markets where there's not a glut of purpose-built student housing. We really focus on affordability, and our projects have really done well. So the SUNY system has Excelsior program where students get a significant discount on their tuition if the household makes under a certain amount. So you're seeing significant growth throughout the entire SUNY system. It's very affordable and you get a great college experience. So we have a property in Albany, upstate, which is in Spartanburg, South Carolina. Again, kind of fits into that affordable student housing experience I mentioned. Here in Houston, we have a project that we were a GP partner on, Ithaca. This was an acquisition of the former Gun Hill property. This has done really well. We did a rehab, and this is one of the best properties in our portfolio. We have a project under construction right now in Autumn in Buffalo, New York. Again, it's in the SUNY system. We really like this. This is a football team. It's a true kind of college experience, 30,000 students in the market. We're really excited for this one to come online next year. The brief description of DMG Investments, and this is our contact information. And again, this will be shared for everyone, so everyone can view our presentation. Thank you for taking time to listen to kind of the introduction to DMG.
Thank you, Douglas. At this time, I'd like to hand everything over to David Goldwasser as our moderator. Welcome, David.
Thank you very much, Anthony. Thank you for having me. DMG, thank you for having me. And I'm very happy to be hosting this webinar with this panel. It was a very good pre-webinar call, and everybody here has a lot to offer. So I'm going to get right into it. I have a few questions that I want to ask, and then obviously we can, go from person to person with any comments on them. Ariel, since you spoke first, I'll give you the first question. This speaks to my heart, I guess, a little bit. Do you think that there are going to be a lot of distressed opportunities, from your position, being in this market, having your company in this position? How do you see and what do you see as far as the distressed opportunities, both, I would say, in debt, which is one of the buzzwords that we know many funds have raised money for, and as well as acquisitions of distressed assets, I guess, both in the multifamily and student housing markets, which you guys excel in?
So for this year, we all know that we saw very, very strong collections in the first three quarters in both multifamily and the student housing industries. So I personally do not believe COVID is the driver for any distress in both sectors. And I also know some owners are taking advantage of the potential to renegotiate their loans with the lenders, which gives them a better NOI, things like that. So I know everybody's struggling, but to be honest, personally, I don't think we will see too many distressed assets in both sectors this year. That's my personal opinion.
Let me ask you, and maybe Doug, if you want to also opine. We see a lot of news reports that schools are, either closing down or not having as many in-person classes. Do you see your geographical locations of your assets being an advantage to you where they are? Are the schools operating at full capacity, or are the students maintaining their residences? Because I've read, many articles, which I'm sure many other people who are watching have, that, the students are not going back. Some of the multifamily people are not paying, the rents. So, is it because of your geographical location or some other factors that you guys are faring so well?
So I would say it depends. For example, in our projects in Ithaca and North Carolina, even though the school announced that they will do the hibernation of the class, but students still want to hang out with their friends. They still want to live with their classmates. So for those projects, our occupancy rate right now is still above 90%. So I would say it depends. Doug, do you have any opinion of that?
Now, I just piggyback on, I mean, students, no one wants to live with their parents during their college years. I mean, that's just a fact. So at the end of the day, people are going to be on campus, whether or not they're online, in person, whatever. Activity is definitely a little bit lower, but at the end of the day, people want the college experience. That's why they pay a boatload of money to go to college, is they've been sold this idea that you're going to make lifelong friends, you're going to have the best time of your life, and people aren't going to sit at home during those years. In terms of students that get financial aid, things like that, especially in certain states where they do have eviction moratoriums, things like that, that can be a problem from a credit standpoint, but not necessarily from an occupancy leasing.
Okay, good. Listen, it's good to hear that there's some calm in the storm, where we read a lot of scary stories. So thank you for giving that for that. So I want to actually ask John Harrington, after hearing what Ariel and Doug just said, from your experience in the finance world, are you seeing that this impact from COVID is hurting the financing of such projects, where the multifamily and student housing, or what is your interaction with these markets? Is it the same as theirs, or is it a little bit different?
Well, I probably have a little bit more of a pessimistic viewpoint on this, because I think there's certain areas that are just destroyed. I mean, you look at some of the student housing in and around Manhattan where, I mean, schools are closed. I mean, these buildings have been sitting vacant for months and months. I mean, I closed a $28 million refi out of a construction loan for the University of Maryland just before COVID hit, and you couldn't do that deal today. I mean, now a place like that, you're right. I mean, what?
To interrupt and ask a question, you couldn't do a deal like that today. Is that the amount of proceeds, or is there a loan at all?
Yeah, absolutely. The proceeds. I mean, the rates right now are fantastic, but you're not going to get the type of leverage that you did before. I mean, there's other functions in these loans, such as reserve accounts that banks are demanding. If you have a student housing building in Nebraska or in certain areas, University of Maryland, to Doug's point, you're right. The college experience is, I mean, it's paramount to people and their experiences in life. But there are places that, and again, there are also assets where some of these owners have used it to their advantage, to whether it be forbearance agreements or opportunities to negotiate a restructuring with their specific lenders. But I would say that there are certain areas that are experiencing significant problems, and some of these owners are trying to figure out alternative ways to find other uses for these assets as well. So I think if you're going to invest in student housing, you got to just be very sensitive as to where it is, the demographic of the student body, and probably the local politics as to how COVID is impacting lockdowns and various other restrictions. So.
Okay, so I'm going to flip a question to you, Doug. Piggybacking off of John's statements. As obviously you guys are actively building some projects, and I understand you're looking at acquiring some new projects that are in the pipeline. What are your capital markets experiences compared to with what John is saying?
Yeah, it's definitely more challenging to finance a project today than it was a year ago. It's significantly harder. What I would say is, from student housing standpoint, and I'll get directly to your question in a second, but from a student housing standpoint, there was a glut of student housing. There was an oversupply in a lot of markets. A lot of people are very concerned about student housing. And honestly, with COVID and everyone stepping back a little bit, I see greater strength for the industry 2 to 3 years out than there probably was 2 to 3 years ago. In terms of financing capital markets, I would say that lenders are out there pretty significantly. Debt funds are pretty active right now. If there's an ongoing recession, there's probably more concern with debt funds and their ability to withstand, as you saw during the Great Recession. But right now, if you get an LP term sheet, it's going to be more expensive than it was. The pari passu kind of pref rate's probably going to be in the low teens. The waterfall is not going to be as accretive. And that's probably for developers who are luckier to not have to go down the pref route. But for good opportunities, there's definitely equity out there. And I think people are more active than they were in March, April. We're looking at kind of distressed assets, maybe in the hospitality sector, and kind of more niche deals than we would have in the past, than just a vanilla ground up student housing development. And there's been a lot of interest in finding deals that have a great basis, kind of a unique story, things like that.
Now, when you're saying you're looking at hospitality, are you looking at that in order to convert into student housing?
Yeah. So you're seeing a lot of kind of select service, extended stay hotels going on the market. And that's an area that we have a lot of interest in. I mean, you're seeing a lot of auctions for failed assets there. People are trying to do a distressed sale. And if you can work a conversion well, you can buy something at a pretty good basis with pretty good bones.
Got it. Okay, great. So we haven't heard much from John Haltmeyer. So maybe let me lob a question your way. What do you see as far as the opportunities, the challenges ahead in the markets? You know, what type of lending or deals are you guys looking at right now?
Yeah, so a slight departure from the multifamily, as you know, as a capital raiser, we sort of see a lot of market trends real time in terms of who's looking for money, you know, and in other times, what?
One hand up money, I'm always looking.
Oh, okay, there you go. I get. You know, so we see waves of commercial real estate, mixed use development, multifamily, whatever. The wave that we're seeing now is a lot from these single and, you know, sort of 2 to 4 unit residential fix and flip opportunities. And there's a interesting dynamic going on when COVID hit. There was an expectation, of course, that foreclosures would be going up, but then on the other hand, the capital that people needed, both the fix and flippers and the hard money lenders, they didn't have access to capital for them. But then at the same time, because of the relief that was being given to a lot of homeowners and small businesses that own investment properties or whatever, there was not as much on the market as anticipated. So, you know, right now there's not, there is limited inventory, and it varies by market, of course, across the country. But, you know, my soundings from various people I know in the marketplace, sort of the lower end, the houses that are 200,000-300,000, some they're 100,000, 150,000, whatever. They're getting working. The banks continue to work with them on forbearance, on modifications, and what have you. Now that's going to run its course at some point. We've got the uptick in COVID. We don't know what's going to happen going forward. We don't know if there'll be new government programs coming in to help with that. What's interesting, though, from the fix and flip standpoint, is that as you get into the higher price stuff, you have a little bit of a buyer bifurcation. So you have people who are in vulnerable industries, like such as retail, what have you, that are in distress. They've got to sell their homes, or they're in foreclosure, what have you. They're higher, more expensive homes. They're not getting the kind of assistance, the kind of leeway that some of the smaller homeowners are getting. And so there is activity from that standpoint. So from the fix and flippers and the lenders to the fix and flippers, they're seeing good activity. The problem is once you buy that house, the permitting, the supply chain disruptions, whatever, is causing delays and getting the house ready for sale. Once it can be sold, it's the stuff is getting snapped up quickly because of these trends, as we've been discussing, of people escaping the cities, Sort of the mid to higher price starter homes in particular are getting bid up through the roof. So that's kind of a big area of opportunity. For the lenders themselves, a lot of them had been originating loans and then selling to the loan buyers. When COVID hit and the loan buyers stopped buying, a lot of fix and flippers, and now we have 2 in the market. We're about to possibly have a 3rd. They want to have some more secure access to capital, committed capital, that regardless of the market conditions, they continue to look for opportunistic lending opportunities. So in terms of the opportunity for us, that's what we're seeing in terms of these lenders, the hard money lenders coming to us saying, hey, we have some warehouse lines, we've been selling a lot of loans, but now we really want to not be dependent on worrying about the market conditions in selling things. So that's kind of where we're seeing things. I think there is an expectation that there will be a lot of distressed opportunities, at least in residential, in 2021. Sort of unfortunately, I guess, in a way. So.
Oh, so one person's unfortunate is somebody else's opportunity.
Yeah.
Sad to say, but that is the way the world turns.
That's right.
Ariel, let me ask you a question. Going back to multifamily student housing, and we'll come back to, I think, some impact both ways on the single family market. But how, the technologies that we have today, Zoom and all of the other technologies, how do you think that impacted your, I guess, the multifamily sector or the student housing sector during COVID now? Do you think that had a positive impact? Do you think it had a negative impact? Or, what do you think that the overall effects of new technology during this crisis have been?
I think overall, of course, the new technology has a positive impact on the current situation. Without Zoom, without Google, we all of us won't be here talking to this kind of conference today. And for the student housing and the multifamily, from the operation perspective, and a lot of projects are using the VR function to help the residents or target tenants to walk through the unit. I saw previously, a couple of years ago, VR functions are installed in those projects which are further from the campus, but right now I saw the function is in even in projects very, very close to the campus, because people need that. People cannot take the in-person tour due to the COVID. So to answer your question, it's a big help in this unfortunate situation.
Again, necessity is the mother of invention, and I think, like you're saying now, that it is a great opportunity to catapult some of these technologies which were not fully integrated into society to be able to help us. Because like you're saying, people I know wanted to move to different states, let alone student housing, they just wanted to move to different states. And the technology today was able to have them not only look at new places to live, but give measurements. You can place furniture, you can see you can stage a house virtually today, versus having to do all this moving and staging. So I think once people got out of the initial shock and awe, we were able to really get creative and take these technologies to help developers and owners move things along without as much delay as everybody had anticipated. I think that's a very good point of view from you, Doug. Student housing is different today than I think it was ever in the past, and I think there have been some cycles and evolutions. What do you think, compared to the past cycles and evolutions, are going to be happening post 2020? You can't say post COVID because it's never going to go away. We'll deal with it, but 2020 is going to be a line of demarcation for some time to come. what do you see happening in the student housing market as an evolution with, I guess, the impact of technology, the impact of new ways of social interaction going forward?
Yeah, there's a lot of questions there, but I would say from the biggest standpoint, from my perspective, for the past couple of years, student housing has gone away from kind of the gimmicky things like the golf simulators. The tanning beds are always going to be important, but there's really a change in the student population where they're looking at more study spaces. Parents are more involved than ever due to the cost of education. They're guaranteeing these leases. So having a really kind of safe, good educational focused experience in student housing has been something that was more important than ever before COVID. And with COVID, you're seeing a lot of new properties have kind of interesting use of technology. They have creator spaces where you can do like a podcast, they have virtual learning rooms, digital whiteboards, things like that, that people didn't really look at in the past, but I think really help sell student housing now more than ever. And one of the big benefits of student housing versus kind of traditional multifamily or a dorm setting is the bed bath parity. And with COVID, I think people are going to be more focused on cleanliness, and having your own bathroom, having a common powder room for guests is just going to be something that's more and more important as time goes on. I don't think that some of the preferences that COVID changed are just going to disappear in 5-7 years, something like that.
Okay, so sort of the new reality as people have made that term. Things are changing to a different reality as what we knew from the past.
Yeah, I mean, if you're scarred for a year, you're not going to just go back to the way you were a year ago. Yeah,
I agree 1,000%. I'm going to make a little bit of another segue. John Harrington, question. You're dealing with a lot of developers and financing and requests for financing. Similar to student housing, I would say there was an uptick in co-living as well as the co-working, where similarly you had a lot of different people going into the same space. And, like Doug was saying, people want to be together. People want to have that experience in college. They want to have that experience. There was a big trend in the co-working, which then led to this co-living designation, which again, I think is just akin to a student housing rebrand, maybe a few years after college, or the people who didn't go to college. What do you see that marketplace doing, or what do you see happening in that marketplace?
I mean, these things that WeWorks or these various different, co-living, co-work type situations for, creative people to live and communicate and collaborate. I think it's off the table. For maybe a long time. I just don't see it. I mean, for the obvious reasons and the health and safety reasons from COVID, but I think all of that it's done. I see more, for what we were talking, for when John and I were mentioning earlier, when, these companies or various companies, they've made their plan B decisions, they're whether it's, their staff working remote or in other locations, their plans have been changed. And I think, there's going to be a desire to get back into the cities, but I don't see these co-living situations coming back. I see more the possibility of more like micro units coming into play for people that are commuting, or people that may do 2-3 days in the city or cities, depending on where you live. So I see more of that as a more of an attractive play, or a prevalent play for developers and people looking for opportunities in that market. But I don't know. I could be wrong, but I just do not see a big movement towards any co-living scenario.
Okay. Doug or Ariel, do you have any viewpoint on that?
Yeah, I mean, co-living, I think only ever made a lot of sense in very dense urban metros where it's extremely expensive. I was seeing some co-living projects in smaller cities like Portland, and it just never made sense to me. But co-working in the WeWork setting, people do enjoy the social interaction. But going back to what I was saying, I don't really know what's going to happen post-COVID and how cautious people will be and how long this will go. I wouldn't want to be in that business.
But you have all the answers.
I wish I did.
All right. Okay, John Holtmeyer, going back to what you were talking about, as you were mentioning some of the challenges and some of the opportunities for the single family or 1 to 4 family fix and flip business, you mentioned that there was a little bit of a stall in the markets for some of the secondary purchasers. How are you guys changing that, and are you offering the borrowers better deals, the same deals? How are you differentiating yourselves in order to keep that market running? Because I definitely agree with your viewpoint that the single family market for sure, but the small multifamily market is very hot. It's very strong. People are looking to move into houses versus apartments in many settings, not in all. People do acquiesce going to work from home and willing to make their purchases based upon spending that they would put towards their business or work. How are you guys able to be different or be unfrozen as versus the frozen buyers?
Well, what we're doing is the structure that we're seeing, and it's taken us a few months to kind of figure this out. So when we take a client out to the market, we generally say, hey, we're looking to raise capital, because we don't necessarily know all the answers on day one. And at least for, so for the hard money lenders, who are generally the ones providing these loans, and the reason is that you don't see it as much from banks is because they're bridge loans. They're not going to be compliant with the banking rules these days, because you can't show a cash flow model that's going to show repayment over a whatever number of year period. These are due 12, 24 months out, whatever. Right. So the hard money lenders, where a lot of them, what they were doing in the past was they would raise either friends and family money or like a fund where they get some kind of Reg A money or something from accredited, or as well as non-accredited investors. And they would, a lot of them would have 2, 5, 10, 15 million, whatever, and then use that to originate closed loans and sell them off. Or they might have an expensive warehouse or something like that. So what we're seeing now, if these guys want to grow and take advantage of things, especially since it's a little bit harder, I think, to convince individuals to kind of come in and to do sort of crowdfunding or whatever, is they have their 5 million or so of kind of friends and family money as like a first loss piece. And what we're finding is there's actually a pretty good appetite of mezzanine lenders to specialty finance companies that are willing to take that next slug. So as long as the hard money lender themselves are willing to say, take that first 10%, we can find people who will take the next 20 to 25%. And then in that case, now we can find other sources of capital who maybe in the old days, warehouse lines or other sort of senior secured providers where they would advance at 90%. Now they're doing 65, 70, 75% that they'll advance at. That's kind of how we can fill out the capital structure. And that seems to be sort of the solution as of now. Now that could change a month or 2 months from now, but that seems to be the kind of solution. And then at least they can have, and typically these warehouses, they're going to be 1 year with a ability to renew. But at least that from 1 month to the next, as long as you are meeting the criteria as a lender, you're going to be able to have access to capital. Now, there are, of course, certain circumstances If there's material adverse changes or whatever, that lines can be shut off or whatever. But for the most part, it's certainly better than, you know, the loan buyer just one day saying, no, we're not taking any more loans off your hands, and then you kind of get stuck with stuff. So that's kind of how we're seeing the market shape up right now.
Okay.
But I have a question. May I ask a question to the our experts on the code?
There'll be an extra 25 cents on the phone.
Okay, that's fine. I was reading today about a gym in which the main trainer had COVID, and nobody got COVID. None of the members got it because they apparently have some amazing new ventilation system that keeps germs from spreading as much. And I'm wondering, because I agree, I think people, just like after 9/11, people thought no one's going to want to live in New York. You know, eventually over time, memories are short, everybody piled back in again. I think that, you know, people really enjoy it. We were in a WeWork space. We loved it. And I think when people feel it's safe, they can come back in again. I don't know if it's going to be 2022 or 23. I don't know if the existing providers will be bankrupt by then. But I'm just wondering if these kind of new super duper ventilation systems, is that something that DMG is putting into their multifamilies? And that could potentially have a big impact, because I think this is going to be the new normal with germs spreading around the world. So there'll be something coronavirus too at some point. But
We're all going to be germophobic.
yeah, I hope I'm not out of line here asking that question, but
Yeah.
if you had any comments.
Tomorrow it's too late.
I think that's a really good question. I mean, DMG, everything is under construction. We already designed and planned, and we didn't really take in consideration ventilation systems. But I think that's something that's going to be really important for all sorts of developments. I mean, most office spaces have terrible ventilation. They're stuffy. If you go to the Goldman Sachs building, they have incredible ventilation. That was kind of their selling point. That was way before COVID. I think at the end of the day, that's something that's gonna be really important. And like you said, it's going to keep going on. We dodged a bullet with SARS 10 years ago, and now we have the new SARS that we didn't dodge a bullet this time. So it's going to happen again and again. People really need to be forward thinking about that.
Yeah, besides the ventilation, like DMG actually is talking to some company who's doing the like robot cleaning, which can be used to all of our projects, even like to some office and hospitality projects. That might be a new kind of thing to like prevent germs from spreading, as you said.
As we get close to finishing here, Ariel, I want to ask you, obviously DMG is very strong, and you know seem to have a very good hold on your markets and your expansion. What are your expectations from this coming spring for your company moving forward? Is it going to be more acquisitions? Do you see a higher level of acquisitions due to some of the opportunities in the market? What do you see for DMG?
So in the past 2 weeks, one of the big news is the vaccine. So for the upcoming like 2021 first quarter and second quarter, if the vaccine is available and proved effective, we may see another like uptrend on the leasing of our own projects. We will see like uptake on the occupancy when spring or summer comes. So in terms of the acquisition, we are still very actively looking for new projects. For example, if we start right now, all of our like projects in pipeline will be delivered in 2021 and 2022. We have a strong belief that at that time, at the delivery, the COVID will be debated. All of the students will be coming back to the university, and the people may come back to the New York City or New Jersey for the normal life. So we are still very positive on the acquisition. We are still looking for new opportunities. As Doug just mentioned, we saw some unique opportunities in hospitality world and also in commercial, like office world, which we might find opportunities to convert those buildings, the distressed assets or like poorly performed assets into the multifamily and the student housing, especially those assets next to the transportation hub or like very close to the universities. We have strong interest in those kind of projects.
Oh, so you're looking at really adaptive reuse to take advantage of other situations of distress, because as you mentioned, you don't feel that the student housing in the markets you're in is in distress. So you're going to try to take advantage of the other distressed opportunities in order to create additional student housing for yourselves.
Yeah, right.
Excellent. Now, flipping that over to John Harrington for a second, how do you see financing those types of opportunities? Do you think that that will be easy? Do you think that will be hard? Do you think they need some type of a mixed use component? Just a quick opinion from you.
Well, I mean, I think it's hard. I mean, when you look at, say, I mean, this, one of the larger, lending pools of money for student housing is, either the Fannie Freddie student housing loan program or CMBS. I mean, you look at the amount of distressed assets that's in their, in their portfolios or in their, on the the special watch lists right now, and it's through the roof. But like I said, there are certain locations where they are a little more resilient, and I think for the right operators that have the right schools with the right demographics, they're getting done, but they're just not getting done, I think, in the with the cash out levels or some of the more attractive financing points that they had in the past. They're built-in protection mechanisms. As I said before, you had these large reserve accounts, that are set aside, in case, there's interruptions and school closings, and, where they'll be able to, service the debt for a while. But I don't know. I think it's definitely going to be more difficult for financing for these assets. So it's my opinion.
I got it. Anthony, I think it's time for Q&A, but you tell me if you want me to ask any more questions before that.
We do have some pre-registered questions that came in. Unfortunately, they were not able to log on this live webinar. So let's stay with you, John. And I have a question. I'm just going to ask each one of you a question because we do have 10 minutes. John, for construction financing, is there construction financing, and where are you seeing these loan types being offered and by whom? This question came from George Eliopoulos from Velios Capital.
Yeah, I mean, the answer is yeah. I mean, it's not the way, it's not as good as it was, but I mean, I'm doing a large scale ground up construction in northern Connecticut right now with a regional bank that's in the upper mid 70s for leverage at a fairly decent rate. But again, the sponsor is a fifth generation development family. So I think the answer to that is if the guys have a decent plan and a good location, but first and foremost, I think they're looking at who are the guys and do they have the experience to do it. I think who they are is really the most bankable part of the transaction right now. But again, with people moving outside of urban areas, there's definitely there's a lot of activity. So it's getting done. I mean, I think gone are the days of the 85%, LIBOR plus 200, type of transactions. These banks want to make money now, so they're charging for it. And non-recourse construction is certainly not as easy as it can be, or as it has been in the past. It is available, but at much more lower leverage points. And like I said, the big guys are fine to take on some recourse for that higher leverage, but it's getting done. It's very active right now.
Great, thanks, John. And if anybody has any questions, now's the time to submit them. Joseph Rolick Malik from New Jersey, Cost Segregation Company. What is DMG's strategy for real estate investments moving forward, 2021 and beyond?
DMG strategy, as I kind of mentioned when I was doing our introduction, we're really focused on schools that have affordable tuition, affordable rent, a good quality college experience. I think that's going to be more important than ever as we move forward, especially if there's a recession. Student housing typically does well during a recessionary environment. This one's going to be a little bit different. But I really think if you're in a market that isn't oversupplied and you're really investing in a project that has affordable rents, that's something that's going to do tremendously well moving forward. And as I also mentioned, we're really looking at kind of opportunistic investments, any conversion opportunities for existing asset that has good bones, a good location that could feasibly be turned to a multifamily or student housing property is an area that we're very focused on. And we're also looking at growth markets. So a lot of our target markets right now are across the Sun Belt from Texas to the Carolinas. And that's really where the population growth is. If you talk about deurbanization or things reverting to the mean, people are still going to be living in the Sun Belt, and there's great tailwinds there.
Thank you, Douglas. Lily Lee from Mortgage World for Ariel. Hi. Multifamily has been on the top of investors' list. How was this trend shaped by COVID?
I would say like multifamily continues to be a very attractive sector for the equity investment and for all of investments comparing to like commercial and the hospitality. The biggest change over the past few months has been a desire for distressed pricing. So I would say it will continue to be a very attractive investment and will be a safer bet comparing to other assets. So I'm still holding very positive on that part.
Thank you, Ariel. Before I ask John Waltmeyer the last question, I would like to ask David Goldwasser his opinion about this presentation and if he would like to add in anything regarding his thoughts about this presentation.
Sure. I actually was, I would say, surprised to some of the answers from Doug and Ariel because, surprised in a pleasant way in the fact that, most of the news that we're hearing is doom and gloom. On one side, you're hearing cancel the rent in New York City. On the other side, we're hearing that they're at very good collections and very great occupancy in their projects. Again, I believe that has to do with geography and picking. And obviously, as Doug and Ariel were both speaking about, they picked very specific demographics and they are choosing very specific demographics, colleges, and the types of colleges, the affordability of the colleges. So their plan is much above and beyond the typical, I want to buy student housing because, of course, a college needs a place for the kids to live, and therefore we think it'll be occupied. And some people have a different way of, it all depends on your investment thesis. So their answers were surprising to me from that standpoint. And happily, and understanding that they're still looking for acquisitions in a different type of distress. As Ariel was saying, they're looking at other sector distresses in order to add to their sector, which they feel is strong and they're bullish on, and by their own metrics are doing well in. So everybody thinks of you see titles on newspapers, on magazines, and the various emails we get, vulture investors, funds are put together. And in my world of dealing with distressed borrowers, and for the most part, lenders don't have the opportunity and the access to enforcement as much as they have had in past cycles and past markets. And they are getting frustrated with their inability to enact all of their rights as per the documents. So, it's a very interesting time. People are not able to just pounce, as the words are, used, as they did in the past in all the markets. Some markets are allowing it, but a lot of the major markets and the large urban centers have been halting and stymieing the effects of the predatory lenders and or even the regular lenders to affect change. So nobody's really, we'll call it, woken up yet. And but yet we hear about closings of stores, we hear about retail centers, we hear about lawsuits over non-paid rent. So at some point there has to be a breaking point. But to be on a webinar today listening to a company that's obviously doing very well and protecting their investors' capital and if not growing it, as they're discussing, then that's a very good thing to hear. And to hear John Holtmeyer talking about his access to capital, which is alternative to some of the other buyers of the aftermarket. John Harrington talking about the stuff he's getting done. Again, he's talking with a little bit more of what we hear in the newspapers and in the media outlets, that it is much more challenging. It is harder. The volumes are down. So that is a little bit more akin to what we're seeing. And one day you hear in New York City nobody's ever coming back. The next day you see there's a $500 million loan that just closed and groundbreaking on a new 2 million square foot tower. So it's a very weird world that we're living in.
Was that loan done by John Harrington?
Not recently.
It should have been.
Hey, David, we have a question here, and this could be answered by anybody. David, thank you. Thank you so much. And you were a great moderator. Thank you all for this terrific panel. I have a question about student housing market. So geographically speaking, which region would be mostly impacted positively or negatively? For an example, student housing in NE, New England, Ivy League region would be quickly rebounded?
So let me take this. Our investment strategy is to focus on the universities, not by region, but we will do our own analysis for the universities. Right now, due to the immigration policy and other policy, we saw a huge decrease on the international students. So for those universities who heavily rely on international students, we will put a red mark or red flag over there. And for those universities who has a large population of students who are relying on financial aid to pay their rent, we will put a red flag over there. So it's not differentiate the property by region, but it's all about the fundamentals of the university itself.
John, I'd like to conclude with you. What is your outlook for 2021?
Well, based on my soundings, I think you have to look at the fixed flip market in kind of three different stratifications. So the upper end, the little more luxury market, seems to have run its course. But again, who knows? That seems to have run its course. So that we expect that to be a little bit more normal, I guess, in 2021. The lower end of the market, that's going to be heavily dependent on how bad is the pandemic, how bad will the economy get, and then the countervailing force is what sort of assistance, what kind of package comes in from the government to protect those homeowners. I think the vulnerable ones, and where there's an expectation where there could be, as Ed mentioned earlier, where there could be a lot of opportunity for the fix and flippers, are more the mid-price to upper-priced homes where the homeowners are in. They're not like essential workers, and they're in more of these in these more vulnerable industries, hospitality, retail, what have you. Those are the ones, they're kind of beyond the reach of whatever, you know, a stimulus check of $1,200 is not going to make a dent for them. And that's probably where things could get very dicey for them. And, you know, as we were saying, one man's tragedy is another man's opportunity. It could end up being a big opportunity from that standpoint. In terms of the capital coming in, from our standpoint as a broker, there's always capital. It's just a matter of where it's coming from and what the price of it is. The high price guys are going to do pretty well. The lower price ones are going to be kind of pulling back and may have advance rates and terms that are just not as competitive. And frankly, they're the ones that they can kind of pull back, and they'll wait for things to for their turn in the cycle, if you will. So,
John, thank you so much.
Sure.
I really want to thank all you guys. You guys did a spectacular job. Thank you, David, for moderating, and thank you, DMG, for sponsoring this webinar. We will be back December 9th for part 3, sales and operations for the new developments. They will talk about the sales record for new developments in New York City and New Jersey, challenges and opportunities for new developments in the tri-state area, new sales and marketing strategies for better promotions, operation challenges, and new development in multifamily residential leasing will all be discussed on December the 9th. This concludes our webinar, and I want to thank everybody and thank all the attendees for Zooming in. Thank you.
Thank you.
Thanks so much.
Goodbye.
Be safe, everybody.